Odds of a downturn are increasing. Investors are rightly worried about the possibility of a recession popping up in the next year to 24 months. And you can start to feel that in the credit markets. Spreads are becoming more volatile as investors price in the possibility of losses arising like they normally would do during this kind of downturn. But it's important to stop and think about where are those excesses in the market. Every cycle is different. And I think right now we're looking at the possibility those excesses are in the syndicated bank loan market, more so than other parts of the speculative grade market, particularly high yield. So for example, high yield right now we think is actually relatively well prepared for a recession. So let's drill down into the high yield market itself. When I look at the broad-based credit fundamentals, they look pretty good. And you look at interest coverage, things like that, leverage and so on. It's pretty good going into this phase of the cycle. Secondly, the underwriting has been okay as well. We haven't seen a lot of aggressive speculative types of underwriting in terms of LBO and M&A activity in the high yield market. And in fact, the high yield market itself has kind of gone sideways. The growth that we did see more recently has come from falling angels, that are in the double B category now from the last cycle during the pandemic in 2020. So overall, when we look at the high yield market today, it seems like it's in relatively good shape going into the possibility of a recession. Okay, so we're at that point in the cycle where losses are likely going to start to rise. And the question is, by how much, right? So when we look at it from that broad-based analysis that we were just thinking about, that suggests that the losses are not going to be as high as they have been historically. And if you look back in history, there's been some pretty bad default periods in the high yield market. So given the amount of spread that's in the market and the kind of losses that we would expect through this cycle, you're actually getting a pretty decent risk premium to stay invested in the high yield market. So we haven't seen the excesses build up in the high yield market like we normally see in prior cycles. So where are they? We think they went into the lower end of the syndicated bank loan market and maybe into the private lending area as well. Why is that? Well, it's been a private equity boom. The private equity companies have been doing a lot of LBOs. They've been buying up corporate America, and they've turned to the bank loan market to fund those transactions. On the demand side, we've had voracious appetite in the CLO market for buying up these bank loans, as well as investors seeking floating rate note instruments while the Fed was lifting rates. So we've seen tremendous growth in volume of the bank loan market. And this issuance has been lower quality. So that's meaningfully different than the bank loan market used to look like 5-10 years ago. Surprisingly, the syndicated bank loan market now has leverage higher than the high yield index. That sounds kind of strange when you think about the fact that most capital structures would have bank loans and then the high yield debt on a subordinated basis with lower ratings and obviously higher leverage. But then when you look at it and you see that there's not a lot of overlap between the high yield index and the bank loan index in terms of issuers. There used to be a lot, 70+% of those two indices overlapped. Now it's about 25%. So what that means is you have a lot of issuers that have just been their entire capital structure has been funded in the bank loan market. Remember, bank loans are floating rate note instruments. From the investor's perspective, that seems like a good thing, and it is. As rates lift, you have less sensitivity to that change in interest rates, and you're going to clip a better coupon. But from the issuer's perspective, that means their interest expense burden is going to lift as well. And we've seen a big increase in the short rates here, so that will be meaningful, and it could be problematic. So the big takeaway here is that every cycle is different. The excesses build up in different parts of the market. What happened last time is not going to be quite the same this time. And the setup today, we feel that most of the losses are going to come out of that lower end of the syndicated bank loan market, the LBO activity. That's where the strains will likely be during this cycle. It's always hard to predict when that's going to occur, but we think that as this cycle progresses, you're likely be advised to look in those areas for some of the weaknesses as opposed to the traditional high yield marketplace.